guys, glad to have you on board again today. I wanted to share to the broader community the kind of early conclusions I've managed to reach out to during my preliminary research on certainly a speculative topic, and we're going to get to set the boundaries of what is actual data and facts, what are the trends, their direction, and when we dive into some more speculative stuff. So today's topic is going to be about crypto financing and the thesis I have built around this evolution that we have had so far, and what are the likely perspective, your forecasting in the general mid to long-term scale that I am into, which is generally bare minimum 6 months, right up to 2 to 3 years, and nothing beyond that because it goes too wildly speculative beyond that time horizon. So this is clearly not something that is going to play out by tomorrow. It's going to play out through the next quarters and years, up to generally 2 to 3 years to get into full market forces. So there's going to be some sort of evidence, which I try to explain as the basis of the thinking process that led me to the potential conclusions and forecasts. And of course, when we get to the forecast, acknowledge that there's no way for me to know the future more than anyone else who has already tried in the past. I just have somewhat of a track record of finding my way into being generally correct. Though we'll see all about that. I'll try not to get into some vague kind of forecasts in which I just try to get proven right by using some blurry descriptions and stuff. I'm going to try instead to be as precise as it can be with detailed kind of in-market forces effects that I foresee as the evolution either validates or invalidates the thesis. All right, first of all, let's get to the pillars. Like, what are the basic mechanisms that led me to, first of all, say that I think something isn't reproducing the previous market state, that an evolution is likely going to kick in. And therefore, in here, talking about crypto financing, you'll be very familiar with VC stuff because that's exactly the way we've been doing it so far, which means externally driven kind of traditional finance, some way of finding its way into debt money to finance those projects building into the crypto ecosystem. Either building infrastructure or protocols or applications, doesn't really matter there. What we're going to look at into is not generally where these investments are going, but the relative share of those investments as the global market cap of whole crypto projects. We're not going to break it down into subcategories like how much is going to infrastructure, protocol building, and stuff like that. We're going to keep it high level there as a general community education stuff. Of course, if you're willing to dive deeper into the thesis itself and contribute to the data, you'll be very happy. You can just reach out to me in private messages, and we can definitely consider releasing some more fundamental paper on that. All right, so here it goes. Number one stuff is to acknowledge the general market structure, taking it away that I have used the crypto other in this, which is basically anything outside of top 10, for the simple reasons that anything that is in the crypto top 10 is by definition something that is pretty well financed so far, despite some exclusions, which we're not going to get into. Let's make that assumption now. This is to say what is already at significant high market cap thresholds is very likely already fully funded and operational. Even though that's clearly an assumption, we're going to still make that one. What matters to us is not necessarily this. What matters to us is the orders of magnitude and the overall structures of market caps and their evolution through time. So we're going to have to go into logarithmic scale there, because otherwise you wouldn't even see those swings. But what matters to see that we clearly have somewhat of a cyclical activity coming out of some range activity with breakouts. So we got a first acceleration cycle, huge consolidation. We're talking about 95 or 85% drawdown there, so huge volatility. Comes out with another cycle, followed as well by the recent consolidation that we had in 2022. Okay, so basically, if we remove now the logarithmic scale to look at the overall trend structure, we definitely have a couple of breakouts, and we have that native overlap, which means, well, we have what is potentially a wave 5 extended structure according to the strategy that I have, which means we can't predict the moment, And this structure is potential and hypothetical so long as we don't break the all-time high for a third time. Remember, the third is the charm. That's exactly what's happening here in wave 5 extended. That means basically the third breakout is going to be the one that is going to settle the value into its final destination. And we know a few things about this destination, that it is always going to settle the value above the trend line that joins the previous two market tops. So we can know that the minimum expectable value target for this trend to find its destination value is somewhat around and higher than $1 trillion, starting with an average value for the current range, which we're building on, at an average value of $250 billion. So somewhat like a 4x. And that's a significant amount to be created. That just means, of course, there's going to have to be new projects, bringing new use cases, new value, and so on. But to reach out those future market caps, which we are expected to settle there, which means prices and market caps can actually top way higher than that, but the stabilized value should be expected higher than $1 trillion. So a minimum forex factor in the created value. In order to create that value, we're going to have to find early financing systems. Basically, that's the way to go. You want to create value, you're going to have to bring some money to the table to finance operations and building either those protocols, infrastructures, whatever. All right? So, of course, as we stated earlier, the number one financial rail for this in the crypto market has been VC funding. Venture capitalists. And if we look at the data itself, the best way I would suggest you to go by is to look for CryptoRank, which has a lot of information regarding fundraising through VCs primarily, and we could see those trends over the long run. Now, if we zoom it out like to 5 years, you would be seeing, of course, that those fundraising are pretty damn correlated to the actual crypto markets cycles. And of course, we see the huge burst of financing requirements and therefore fundraising in the crypto market when the bull run starts to kick in. So one thing we can say for sure is that yet this is another data point suggesting nothing has started yet. Lots of people have maybe overexcited themselves with this first peak out of the bear market in here, suggesting that there was still life in this ecosystem and that we might be eventually having another cycle. But for now, we're still in this digesting phase, awaiting for further financing to reach out the market as the true bull market start to kick in. And until then, like we stated, people might anticipate that and try to time the market in. We're not going to be doing such a thing. We're just going to wait until the actual third breakout happens. It should be backed by data points suggesting that fundraising is rising back up again. But the number one caveat to this is, well, I don't think the actual financing capabilities of VC markets can actually sustain this minimum 4x increase that we expect. If we correlate one-to-one to the expectable market cap, that's what we suppose. That's we would like to get 4x the fundings that we have seen throughout 2021 to support the further growth that lead us to final market valuation somewhere around 1 trillion and settle above. So that's really all there is. Do we really have sufficient financing capabilities for VCs, which most of them are still in their initial investment through long vesting schedules and so on? I don't think we have them. At least we might see some growth, but call it that way. At a minimum 4x, with the same level of VC funding, we would be able to fund just 1/4 of the next cycle growth if we just manage to find just as much VC money for the next cycle than we had on the previous one. Assuming that there is still going to be new VCs in town joining the rally, let's say that we could roughly finance 1/3 of the next necessary capital input for the next cycle. That still leaves us with a huge hole on financing capabilities. And the question that arises with that is, who is going to step in and provide those finance necessary requirements? All right? This is the basic understanding for these theses in here, is to state that I hardly believe that we're going to replicate the previous cycle in which VC money has taken a huge grip on the overall market structure by the heavyweight amounts that they're bringing into the table. Because we've already seen the distortions of this throughout the previous bull market and this very violent and painful bear market that arose after 2022 with those massive VC liquidation and cascading events that just crippled the entire market up to this day. The consequences of this, I would say, are deeply rooted in these over-leveraged VC bets and the nature of their return on investment strategies. It's the fact that as they rose significant amount of money into inherently risky capital markets, well, therefore, they had to claim for significant shares of the diluted supply of the companies that they were actually financing. And what we've seen, therefore, is the huge emphasis out of the historical way of financing stuff. We've seen the Ethereum ICO era among those as preliminary stuff, just to set that as the VC took more grip into the ecosystem, we've seen much more emphasis into diluting the supply for those VCs. Investors taking a huge share of the actual supply of those foundations or protocols or whatever. And by doing this, we need to understand the clear separation there is between a public sale and a private sale, due to the fact that the nature of risk over return, the ROI, is that basically those venture capitalists dilute their risk towards many candidates with different proportions depending on the risk assessment they made on the proper due diligence stuff. What we've seen on top of is that, well, most of the time, the strategy itself is that when I distribute to someone like 20 or 50 candidates, there are probably going to be 2 or 3 that's going to be the unicorns, the big ones that definitely brings a hell lot of ROI. But on the other hand, some just roughly go higher, but they're highly illiquid, which means I can hardly sell the token without crashing it all, not to account for those who don't nearly hit the market, which means I basically finance a project, but nothing ends up being delivered in the end. The guys just basically burned the money and delivered nothing. It's very much happening, and most people are not necessarily aware of it. That means, well, somewhat the overall balance of return on global investments, the successful one, the unicorns, the less successful ones, the most illiquid ones, and on the other hand, those who don't nearly go to market. The actual VC need to figure out a blend of all of this in their risk management strategy, which means even if the unicorns is performing very well, they still need to somewhat compensate for the losses that's been performed in other investment strategies. And this is a global allocation which is meant to provide capital returns. What you need to understand is that the VC, some of the VC are there for longer-term exposition to the assets, but most of them are pretty damn short-sighted. And that's the big problem, because as they had a big grip on the actual financials of the companies by having significant primary shares in the token distributions, with a more short-sighted kind of market conditions, due to the fact that the bear market hit pretty hard, they had to sell no matter what, just to finance their operating costs and the return on investment for the investors. So that's really how we ended up into this big mess. Big problem in the actual tokenomics distribution and the misalignment between private interests and actual public companies building on public good systems. And we've seen the nitty-gritty of this. And by combining those two elements, the fact that we probably have reached maximum financial capabilities from the venture capitalist market, and that we have already seen through this bear market the negative consequences of these over-leveraged kind of venture capitalist, short-sighted kind of perspective throughout the life cycle of assets, which is basically, well, the VC cycle and the lifespan of an asset is pretty short-lived. It's generally not extending more than 2 to 3 years, as they're trying to dilute during the actual demand phase coming from the momentum trader. When the asset is rising like crazy, generally trading secondary stuff, which means trading the rate of change of the rate of change, which means you need to have rising rate of change on your preliminary cash flows. This is where the momentum traders are going to be interested into eventually buying it. They're definitely short-sighted and know that their investments will be short-lived. It's more like trading than investing, but this is definitely the counterparty for the VC investment. These are the guys buying into the VC shares, which led us to this dangerous game in 2021 and the following years of actual VC money creating fake growth out of nowhere to sell their fucking tokens. And that's been very detrimental to the momentum traders, who sometimes have discovered afterwards that the data points were fake, and that, well, therefore the momentum was pretty damn artificial. And when they figured that one out, they were holding pretty much overvalued tokens, which means this financing problem, misalignment between the actual venture capitalist business model of distributing risk around right across our assets, and on the other hand, the fact that there is high risk of just not delivering on top of, well, that brought us to VCs overhyping some of the stuff to just get rid of their supply and find their return on investment for their initial investors, leading the momentum trader into either doing their research and finding out the true legitimate actors, or figuring out afterwards that they were just being sold pretty damn expensive tokens, which on top of dilution will come over their head for the years to come, as VC just managed to take the profits out of the liquid share of their supply, most of it being vested for much longer durations. So it still means huge dilution overhead, with the high likelihood of just failing the company throughout this actual chasm period, where there is high requirement of debt and the high likelihood of not finding someone suitable enough to find the money for you, which means you fail on financing capability, failing to distribute on the actual net loss reduction. Basically, you're still operating at a loss because basically your revenues are far outpaced by the level of debt that your company has against those early investors, among others. And in that perspective, in order to further down the line turn to profitability, you need to be able to keep operating profits without inputting new debt in the system. And so many companies fail into that very particular area. All right? And I think that has caused an over-amplification due to the nature of the misaligned distribution of token supply, due to the misaligned interest of over-leveraged VC requirements during the previous cycle. There were too much VC money raised, which caused too many token supply to be widely distributed across those private investors, which most of them are short-sighted and selling to momentum, leading some of them, not all of them, to overhype their project, causing them to crash like crazy and basically just destroying their further capability to ever wake up again. They're just destroyed, going 95% plus drawdown out of the all-time highs, not to mention the further dilution that were coming from the long-end VC schedules. And in that perspective, well, there's not even a chance that these projects will ever succeed. They will die out from this bear market without a chance to wake up again. Too much dilution forehead, not enough growth, and basically they'll never turn out to be profitable. So no one is going to buy into those projects, which means we're left with a bunch of debt that will not be refinanced. That will just be basically destroyed. These things will go down to zero on illiquid token supplies, which means the VC likely have accounted for these losses already, but the momentum traders are the one bearing the most losses in here. All right? So I think that's the state of the market as it is today. Now we're diving into the speculative analysis. As we combine all of these preliminary informations that we just shared, there's high likelihood that there is not enough financing capabilities from the VCs, and that the distortions that we've seen from the previous markets are not necessarily creating longer term aligned value, but more short-term speculation, aka we create but we destroy. In that perspective, I don't think, due to the nature of the technicals we've highlighted, setting that this is the third and final breakout which will settle the value this time around, I don't think the short-sighted alignment are the ones that will drive this market. Though, one might wonder what could change, how this thing could evolve. What I would tend to say, my emphasis in the market has always been using the experience I have into traditional financing systems and all sorts of stuff to say, well, the crypto market has taken huge inspiration from this. So what I would tend to say, and this is speculative, I think we're going to look at the other side of that mirror and saying the answer to this probably lies in the existing traditional financing system, and we're probably going to mimic and replicate somewhat similar systems within crypto. This is my thesis of, I think, commercial banking kind of related activity will find their way into crypto replicated. That means decentralized commercial banking. And by doing that, I built an entire thesis around that, explaining that the Cosmos ecosystem is likely the good infrastructure to do such a thing, but not just all of it. It means financing is a complex rehypothecation system of debt collateralized deposits and stuff like that. Though that means, to me, Bitcoin and Ethereum has a significant share into the system of being the collateralized deposits. But on the other hand, what's going to distribute this system is likely going to be the Cosmos ecosystem. Because it has this horizontal scaling, this governance property, which means you can retain control and sovereignty over your own infrastructure blockchain, custom tailor-made to your own needs. This is perfectly suited for enterprise-grade building stuff. App chain thesis. basically. So I'm not going to go into all the details of that report because what we dive into in here is more on the financial capabilities. So we're going to look at existing kind of banking infrastructure and its global kind of architecture. And just to set what we're actually talking about is the company's financing rails, which comes from two sides of the equation, the commercial bank and investment banking. Basically in here, to set things really easy to you guys, it's a simple difference between the size of the financing capabilities. Between the investment banking is much more able to distribute much higher end kind of financing to big companies and corporations. We're not yet there, I tend to say, in crypto, probably in a future cycle. Well, we corroborate the likely probability for us to create new stuff the cycle around is going to mimic commercial banking. By doing this, we need to look at what are the commercial banks' actual activities. They are looking for payment and cash management. So once again, I think blockchains are perfectly suited for this, but as Cosmos provides sovereign blockchain infrastructure, I think sovereign end-to-end B2B2C payment rails are likely the ones to take on these market shares, which means it's not necessarily per se a payment infrastructure, as the payment infrastructure is horizontally distributed on a common of a peer-to-peer basis, like business to business to consumer, B2B to C. That's exactly what's been highlighted in the report, by the way. So if you want more information into this, I'll eventually think about putting a link in the description, or otherwise you figure your way out of this. It's been published in the Discord, among others. What matters to me is this, because I think this is the infrastructure that's getting to be built and distributed more across and more widely, and this one as well, because these two are intrinsically related. Deposits and lending is the heart of the commercial banking system. That means basically we have collateralized deposits and other enterprise deposits. I mean, the cash accounts of those companies can be used to lend out this money to some other companies. Of course, accounting for a risk factor, which means if I lend out the money and if the actual creditor ends up getting out with the money and not paying back the interest, well, then I'm fucked with the deposits that I lent out, which means I need to suffer a loss. In the current financial system, the beauty of this is that, well, of course, when the deposits are fucked, what we do is that we basically create the money that maces. And that's a big problem, because bank bailouts are actually a problem of risk management. It means the money that's been lent out was generally under-collateralized, and we need to mention that very clearly. And we're going to talk about that again. But the prospect is regarding those deposits and lending. That's the real big job that commercial banks are doing. And, well, if we need higher financing capabilities over just venture capitalists, which is just basically these kinds of stuff, the private banking, financing private activities, well, we need more. We need some more and larger scale financing rails. And if we look at the other side of the mirror, the traditional finance, this is where generally company turns to get their finance. So I think we're going to see the same thing happening in crypto this cycle, due to the combined factors that we aforementioned. All right? And if we have that, then we need to have a deposit and lending facility associated with a risk management performed by those commercial banks. But the first thing is we need to figure out deposits, which means if we need to finance enormous amounts of money, you need to understand it's all about collateral. We have two prime type collateral now in the crypto markets, which are nearly recognized as commodity. The first one's already Bitcoin. The second one's likely going to be in a not so distant future. It's going to be Ethereum. These two are well enough established and liquid to be collateralized deposits, which means I think most of the deposits will actually turn out to be Bitcoin and Ethereum in either direct forms or indirect form, being direct deposits, okay, like lending facilities. You deposit your Bitcoin into a creditor, which is going to take that money and pay you back at a later date with interest rates in the meantime. But these are like, for example, the Aves of this world. But these are over-collateralized loan, which means you need to bring something to the table that had at least similar value to what you're borrowing against. And that's really all there is. These over-collateralized loans certainly have hell a lot of use cases, but I think they're not necessarily suited all by themselves. They're part of the equation, but not the entire solution, because the financing capabilities that we're requiring there are so significant that I doubt these Aves and the like are enough to perform the leverage we need. So we need to dive into the risk management of under collateralized loan or illiquid collateralized loan, because that's exactly what we're mentioning. Remember that earlier. That means you're generally getting a promise of a future token distribution, a claim on future value. And that is what's supposed to bring back the actual revenue on investment. So on that perspective, it's all about the risk management of either potential default or partial default, or valuing the actual go-to-market strategy at a later date, like discounting the future cash flows properly and so on. This is really professional commercial banking type stuff. This is far different from the actual VC stuff, because in here we're looking at real cash flow, not just the second derivative of early cash flow in the lifespan of the asset, trying to create hype just to sell on top of retails or momentum traders, and just try to kind of risk manage globally across a wide distribution of assets. This actual commercial bank generally creates long-term ties with the companies. They also sell a wide array of other services on top of this, not just bringing down the money, but generally advices, advisories, and stuff like that. Lots of things are generally put in top of just the financing capability, because it is in the interest of the actual commercial bank to have a successful company that will turn out to profit at a later date. And this seriously changes the narrative. And that's the reason why I think we need to have those talks today, because I'm definitely into the speculative realm. It's not happening now. It's not going to happen necessarily in a couple of weeks that come. But I think in the years to come, 6 months to 2 to 3 years at best, I think we're going to see those changes crippling over time, slowly but steadily. But under the hood, this is where the smart money is going to flow into. I think the commercial bank is going to find its way into the crypto, financing directly or indirectly, bringing out their knowledge and their experience in risk management, deposit and lending facilities, and doing it in a decentralized way. I've made my choices. I think the Cosmos ecosystem is the perfect infrastructure to do such a thing, but not necessarily the only one. But we're looking at widely distributed horizontal levels because we're talking about financing individual companies. We're not talking about just building layer 3s below layer 2s or whatsoever with this critically vertical alignment. Once again, financial banks or commercial banks generally tend to finance operation, and they somewhat have generally a claim on the equity on top of. But they are intermediaries. They're not controlling the companies per se. So this is why I think we need to think decentralized in here as well, and sovereign infrastructure, not kind of vertical integrated building. And by doing this, well, we've answered the question. I think that's where the actual financing rails of crypto companies are going to head into the next cycle. I think this is where the innovation is going to be. And I think that, among others, the big headliner participants for these things to materialize are going to be decentralized, non-vertically integrated ecosystems, widely horizontal and distributed infrastructures, open source generally, without nearly like you need to buy this token to do this or whatever. It's a free, open, horizontally integrated system, fully fractal. And in that sense, well, commercial bank is just a service you create on top of this. How do you manage deposits and lending? Meaning, how do you figure out debt collateralization and liquidation is happening correctly? Because once again, risk management means proper liquidations when they have to happen. It's a matter of risk limitation. If you fuck up your risk, you need to be liquidated, and someone needs to decentralize that liquidation so that the system is efficient. And I think that's all the things that are going to create a whole lot of value creation within the next cycle. Not just because of this, but because if we want to have a new cycle into crypto, we're going to need to find new financing rails. And what I said is that I think these financing rails are already being at play now. It's just people don't see them because we are financing the early stages of those things. What I think is the evidence of this is that when we look at these data points, we see that something isn't replicated correctly to the previous cycle. We might see this burst of VC funding, but like we stated, I expect them to be somewhat similar or slightly higher than the ones we had in 2021, when the true financing capabilities were probably multiples of that. By doing this, that means external way of funding will happen, probably more long-sighted, but therefore much more risk-averse kind of funding will likely happen. This is perfectly suited for somewhat similar to the current traditional funding rails of commercial banking. Therefore, I think commercial banks are going to step into crypto, find their way into digitalizing some of their actual activities, financing directly or indirectly companies for claims on future tokens, which means it's going to change as well the token distribution. And I think that's the end of this. This thesis predicts that I think the funding will alter the distribution of tokens within the next cycle. The projects that are going to be created throughout the cycle will definitely look far different from the actual token distributions and tokenomics that we've seen in 2021 and before. I think we're radically going to change that with much, much longer claims on vestings, with much broader participation of those early financing, which is going to be much, much broader number of participants. But on the other hand, they will severely specialize into certain areas. Like we see commercial banks specialize in that activity sector or that activity sector. That are the kind of things that we'll see as well happening within that newly created funding rail for a commercial bank replicating into crypto. By looking into this, like I said, I think the financial deposits that will be highly used within those systems are going to be Bitcoin and Ethereum through different forms, and I'm going to be very specific with that. I think collateralized deposits into lending facilities or wrapped tokens are going to be very efficient. I think particularly in here about like wrapped staked token when it comes to Ethereum, which brings a base revenue on top of and brings significantly interesting kind of rewards to finance. Remember, that means you can still get paid with the reward of Ethereum on your initial investment. That means the investment projects need to deliver at least that earning, otherwise you're just going to close the loan. You're just going to say, okay, you know what, I'm not bringing enough revenue, I'm taking back my ETH. Sorry about that. Give it back. That's how it goes. Remember that. To me, I think that's what's going to set the first ever crypto rally, which is going to sustain most of its gains. Certainly, some shitty projects will collapse, which means we're certainly not going to avoid significant drawdown after the end of this cycle. But I think it's not going to be nothing compared to what we've seen before. The value that's going to be created is probably going to be much less widely distributed, because it's not like just going for 30 or 40 assets or 40 projects and trying to risk manage VC type like over the cycle. 3 that succeed over the rest who just shine less or don't shine or don't even come to light. But on the opposite, we're going to find longer, more sustained development phases, constant funding, not necessarily just raising one time and go over with it, but multiple finally raised assets with guarantees, sometimes under collateralized, which means there is a risk management and a risk of default that's going to happen out of this. And I think this is a much more interesting world to live in. I'm very excited for the forthcoming cycle. I don't know necessarily the nature of the actual value that's going to be created, but I know one thing for sure. An actual probable similar type commercial banking activity is going to have to be created within the crypto sector, and this is going to drive value creations. Because just like the bank have been the underlying infrastructure required to create the economy which we are in today, I think if we want to have a flourishing crypto economy, we're going to have to replicate that as well. That means we're getting out of infancy, we're getting into a dollar cents in here at least, and it's going to be for the best. I think the VC era of crypto is now behind us. It's not necessarily erased, we're still young, but we're growing, and we're growing fast. These are the things we need. These are the things you need to understand as well. That being said, I'm going to leave you guys with that. Have a nice day. Bye-bye.